So let's talk about the real estate market, something that I look at every day. I think there's a lot of thoughts about what's going on, right? You've had the 30-year mortgage go from 3 to 7, maybe 8. Some people are calling for 10. We've seen inventory collapse. We've seen transactions collapse. We've seen price come in a little bit since the peak. But there's a lot of things going on. And one of the things that I believe, much like your business discussion in the last video, is creative financing, seller financing is going to be the way that most deals get done, certainly next year and maybe even the year after, because at 10%, very little makes sense.
Yeah, absolutely. Will we get there? I don't know. I was just looking at the Fed funds rate while you were talking. 10 years at 4.23 right now on not Fed funds rate, but treasuries, 10-year treasury, which is kind of loosely what, mortgage rates are based on. And there's generally a delta there of, a couple hundred basis points. But I think rates are clearly above 7% now for most. You can get some interest only stuff and some, longer term mortgages, there's some exotic products out there coming up reducing the rates. But I think the cheapest you can get even interest only now is still in the 6s, isn't it?
Yeah, I think there's a lot of, 2-1 buy downs like you use to buy your house. There's some ARM products out there. But yeah, generally speaking, as of Friday, 7.32 30-year fixed, owner rock, best credit, 20% down. Pretty wild.
Yeah, it's crazy. So will they get to 10%? So I mean, as long as the 10-year keeps popping, it's going to put pressure on rates. It seems like, I mean, we got to 7 much faster than I thought we would. 8 is the next level. I mean, if we get there, yeah, it's just locking people in. And see, that's the biggest problem with the housing market right now is obviously, most of the people in their houses have sub 4%. There's a good percentage, sub 3%. Most of them have good credit, good jobs, but good down payments, those types of things. So how do you get sellers motivated at scale to really affect the inventory or lack thereof that we have nationwide? And, there's a couple of ways. So one, we're seeing some markets that had a lot of influx of people during the pandemic where people are moving out now for different reasons. So you're seeing some inventory levels build in some of those markets. They're bigger markets. You have builders that are delivering units. Builders can cut and will cut, faster than anybody else to, get rid of their inventory. But that's kind of adding a little bit here and there. There's some builders that are having trouble selling. Their traffic is non-existent now, but they can cut and get them sold. Then you have short-term rentals, and that was a big thing. A lot of people, bought short-term rentals over the last couple of years and put those in service in markets where you generally wouldn't rent something on a weekly basis or short-term basis. So as bookings decline, which I know in a lot of areas, some people are having issues with bookings right now, especially since the world is open back up and it's easier to travel abroad. That's obviously going to put pressure back on that market again. So you're going to have some of those people that are going to be forced to sell because they can't rent to cover their mortgage, depending on what they paid for the property. And there won't be as much demand as there was, in the middle of nowhere for a short-term rental. There's a lot of them out there. But again, none of those things are systemic enough at scale to really add to the inventory levels. So you end up with a problem that we're in right now. And some of the people trying to sell some houses in some areas, just can't because their prices are still just way overvalued. So the only option for somebody who needs to sell that can't, and a buyer that wants to buy that can't, is to create some sort of a creative solution.
Yeah. If I was a real estate agent today and I was, a listing agent, which had a crazy easy job for the last 2 years, today is pretty tough. I would definitely start learning seller financing. I would ask every seller what their equity position is, because again, you could throw something on the market in seconds, but that doesn't mean people are going to show up. This is not last year. So at some point you have to go back to the seller and basically, hey, do you need to sell or do you want to sell? Because if you want to sell, let's take it off the market, wait till March. We'll see what happens. But if you need to sell, can I add some language around seller will take back a second, or maybe something very popular in the 1980s, a silent second, right? No payments, but there's equity there that's paid off in the future. There's just, if you need to sell and nobody's showing up, you can either whack the price, which actually I just put something in contract for the first time in 8 months. It was listed at 269. It was like a 320 ARV. We got it for 203. So I mean, if you have the equity in the position, you could do that. But maybe the better answer is to seller finance it. Do you want to maintain some income? Yeah.
And you know, what's interesting is, you know, some markets and some people are still reporting, you know, multiple bid situations. Now it's not, you know, 20 offers or 30 offers, but it's 6 or 7.
Yeah.
So, you know, there's even in my market, I mean, that's still happening where you're getting multiple bids, properties are selling in days. So, you know, if the
Yeah.
right thing comes on in the right area at the right price, it'll get sold. But there's a lot of properties that are, you know, overpriced that are still, you know, early 2021 prices, much less,
Yeah.
you know, the market turned in the summer of 2021. So that was the peak. If you didn't sell before, well, I guess it kicked a little bit more towards the end of last year. Probably into December, maybe the first part of this year. I guess it really started to turn what, February, March this year.
Well, if you look at the, the Case Shiller and all of those folks, May was the peak. Nationally speaking, there were markets that obviously peaked earlier and later, but nationally speaking, it looks like the highest number was May 414 nationally speaking.
Okay, yeah, because the rates kept going down. That's yeah. So it peaked a little bit last summer. It slowed down, then it kicked back in, and yeah, I guess the spring of this year was the last big push, and then rates started skyrocketing from
Yeah.
there. And it's all interest rates. It's like you and I talk about the whole time. And you know, I
Whole
know
time.
there was a little bit of pushback where people said, it doesn't have anything to do with payments. It absolutely does. You know, that's, you know,
Absolutely.
most people are buying a payment. And right now, going from, you know, where we were to where we are now with rates, you know, it's extremely punitive. It's just people are just priced out of the market, and sellers are locked into their houses that, you know, locked in those low rates. So I don't know what. So the question is, how do you get motivated sellers at scale, right? I mean, to correct this situation, it's just a very
Yeah.
interesting time because the remote work situation, people don't have to move for jobs. You know, the rental market is still strong in most areas. So if you can't sell, you could rent. You know, there's just so many things that are different now that just weren't there 0809 and last few years. Lenders, if you're in trouble, they're going to work it out with you. So if you or you lose your
Exactly.
job, and
Yeah.
with what's going on, lenders, you know, you can buy an extra
Forbearance
year.
check.
Yeah. So I mean, it's just a completely different time right
Yeah.
now, and the only way to do it is to build our way out of it. But you can't do that because you can't sell them, and prices are
Yeah.
still high. You can't get the help. I mean, all the builders that I work with, they
Yeah.
still, their subs are still busy, so it hasn't fully corrected yet. You know, I know they're saying housing recession and all that, but you know, again, that's on the mortgage and the lending
Yeah.
side.
That's a
So
transaction recession. Yes.
right. Construction is still finishing out jobs that they're working on. The builders that I'm working with, they're not laying off yet. We're talking about it. You know, they're like, hey, what happens if I can't sell? What do I do? Then I'm like, well, you got to trim, you know,
Yeah,
and
exactly. Get
you need to be
small.
ahead of that, and you need to look at your trends. And most people obviously are going to get through the end of this year and see what they're going to do
Sure.
next year.
Mm.
But that's where builders are right now. People are talking about, you know, builders aren't laying off, they're not pulling back. Well, they got to finish what they have in the pipeline, and they don't want to let people go in the holidays if they don't have to. So I don't, again, I think you're going to see a lot of things culminate into the first Q1 next year real fast.
Yeah, I think Q1 next year makes a lot of sense. I think, because I've been thinking about the housing, I think about the housing market every day. Right? That's my thing. And I always ask myself, what could cause waves of motivated sellers? Because again, that's how you break this, right? You can't have falling inventory and have a crazy drop in prices. That's not how the system works. In order to do that, you have to have inventory coming on faster than supply is being removed. And thus you have to have inventory go back to 2 million units or whatever it was in 2018. The
Yeah.
only thing I can think of today, because again, there's a organization that talked about 93% of residential loans are fixed below 6%. Right now we're over 7, we're heading to 8 maybe. It's just like there's no pain there. There's no force. If we got to 8, 9, 10% unemployment, and if we were at that level for a year, that might start to cause enough pain where people are forced to sell. But that's a lot of ifs, ands, or buts, because again, you have forbearance thrown in there. You have I can't right now think about waves of sellers. Could Airbnb cause it? Yes. Could that be local? Yes. Is it going to be national? No. iBuyers destroyed some markets like Phoenix and Vegas. Will that cause pain? Absolutely, but not nationally. Right?
But you know, I saw something the other
local.
day. Was it Zillow or Open Door? Somebody finally, no, Zillow finally sold
Yeah, Zillow. I saw that. Yeah.
their last house that they bought in their Z buyer program. And you know, while you were talking, so what's going to get rates to, you know, 8 to 10%? I mean, you got to get the 10-year above 5% in order to,
For
you know,
sure.
even start talking about 10%. But to get it to 8, I think you'd need a 10-year in the fives. Last time we saw that, was 2007.
Oh,
So
wow.
10-year hit 2006, hit 5, it contracted, then popped back up, and that's been it. And the highest, we are approaching the highest level on the 10-year right now since 2008, June of 2008. And that was at
Wow.
about, well, 4.2%. We're right there, just peaking above that June 2008 level. So that's what you need to get the rates up. That 10 years got to get up over 5%. And we're at 4.2 right now. So we got a little ways to go, but it's been parabolic. And
Yeah. I
yeah,
think
I'm
we
looking at
get
the
there,
chart
right?
right now while we're talking.
Yeah, I think we get there, right? Especially if if the Fed gets their terminal rate, because right now the Fed funds rate's 3%, right? It's 3 to 3.25. So roughly speaking, there's a 1% margin between Fed funds and the 10-year. Not saying that can't contract, but that's just where we are today. If they get terminal rate to 5%, you have to think the 10 years over 6, right? Just logically speaking.
You would think,
Yeah, you would
but
think.
well, that's a ways off from here, and
Yeah.
a lot of damage to be done before we get there.
Yeah, exactly. Exactly. Well, Greg, this has been so much fun. I always appreciate our conversations. Where can people find you?
GregDickerson.com. That's where all my info is. Go check it out.
Awesome, buddy. Thank you so much for all you do.